Most people are about to lose a massive chunk of their money in 2026, and they won't even realize why until it's too late. But the people who understand one single concept, compounding, are about to get significantly richer because of it. Here's the thing about market crashes. Everyone treats them like some kind of disaster. And yeah, on the surface, they look scary. Your portfolio drops. The news is full of panic. Your friends are freaking out. But if you actually understand how money works, crashes are one of the greatest opportunities you'll ever get. The problem is most people go into a crash completely unprepared. They haven't set anything up. They haven't thought it through. And so when it hits, they panic, they sell, and they lock in losses that they didn't need to take. Today I want to walk you through exactly how compounding works, why a market crash is actually one of the best times to take advantage of it, and what you need to do right now in 2026 to come out of this better than you went in. So make sure to stay until the end, leave a like, and let's start. The stock market in 2026 is showing some patterns that have shown up before every major crash in recent history. I'm not here to fearmonger, I'm here to be honest. As of early 2026, the S&P 500 has had a historic run. Valuations, meaning how expensive stocks are compared to the actual earnings of the companies, are at levels that, historically, have almost always been followed by some kind of significant pullback. The Shiller PE ratio, which is one of the most reliable ways to measure whether the overall stock market is overpriced, is sitting well above its long-term average of around 17, when it's been at similar levels before, like in 1929, in 2000 before the dot-com crash, and in 2007 before the financial crisis. Corrections followed. That doesn't mean a crash is guaranteed. Nobody can predict the exact timing. But it does mean the risk is real, and pretending it isn't is the worst thing you can do. So the question isn't whether you should be worried. The question is, what do you do about it? And here's where most people get it completely wrong. They think surviving a market crash means pulling all their money out, sitting in cash, and waiting for things to settle down. That sounds smart. But in reality, it's one of the most expensive mistakes you can make. And I'll show you exactly why in a second. Let's start with the basics, because I think a lot of people have heard the word compounding, but don't really feel how powerful it is until they see the actual numbers. Compounding simply means that your returns generate their own returns. So if you invest $10,000 and it grows by 10%, you now have $11,000. Next year, that 10% doesn't just apply to your original $10,000, it applies to the full $11,000. So now you earn $1,100 instead of $1,000. Then next year, 10% of $12,100. And it keeps building on itself. Over short periods of time, that doesn't sound like a lot. But give it time and it becomes genuinely shocking. That same $10,000 at a 10% average annual return, which is roughly the historical average of the S&P 500, turns into about $67,000 after 20 years. After 30 years, it's over $174,000. And after 40 years, it's almost $453,000 from a single $10,000 investment with no additional contributions. That's the power of compounding. Time is the engine. Albert Einstein's often credited with calling compound interest the eighth wonder of the world. Whether he actually said that or not doesn't really matter because the math backs it up completely. The reason compounding is so powerful is that it rewards patience above almost everything else. It doesn't care how smart you are. It doesn't care whether you went to college. It doesn't care whether you can read a balance sheet. It just rewards time. The longer you let it run, the more powerful it gets. And here's the thing that people don't always think about. Compounding doesn't just apply to money you already have. It also applies to the shares you buy in the future. Every month that you add money to your investments, you're adding new fuel to the compounding engine. Which is exactly why a market crash, as counterintuitive as it sounds, can actually be one of the best things that happens to a long-term investor. And another best thing that can happen is that your YouTube channel finally reached monetization, and so you can invest much more, since YouTube is the golden opportunity of this decade. And if you want to understand how to do it, I can help you in my free community with the link below. Now here's the critical part that most people miss. When the market crashes, one of two things happens to compounding. Either it gets severely damaged, if you panic sell and sit on the sidelines, or it actually accelerates, if you stay invested and keep buying. Let me explain both of those outcomes because they paint completely different financial futures. What happens when you panic sell? There's a famous study by Fidelity that looked at what would happen to $10,000 invested in an S&P 500 index fund from January 1st, 1980 to December 31st, 2022. If you just left that money alone the whole time, you'd have ended up with just over $1 million. Not bad, right? But here's where it gets painful. If you missed just the 5 best trading days during that entire 42-year period, 5 days out of over 10,000 trading days, you'd only have $671,051. And if you missed the 50 best days, you'd be left with just $76,104. That's a $924,000 difference from missing 50 days out of more than 10,000. Here's what makes that even more significant. The best trading days almost always happen during or right after market crashes, when things look the most terrifying, when everyone is screaming that the world is ending. Those are the days you absolutely cannot afford to miss. But if you've already sold everything and moved to cash because you were scared, you miss every single one of them. This is why panic selling doesn't just hurt you in the short term. It destroys the entire compounding chain you spent years building. What happens when you stay invested and keep buying? Now let's look at the other outcome. Let's say instead of selling during a crash, you not only hold your investments, but you actually keep buying while prices are low. This is a strategy called dollar cost averaging, and it's one of the most underrated tools in personal finance. Dollar cost averaging means you invest a fixed amount on a regular schedule, say $200 every month, regardless of what the market is doing. When the market is up, your $200 buys fewer shares. When the market is down, your $200 buys more shares. Over time, this lowers your average cost per share, which means when the market eventually recovers, and historically, it always has, you benefit more than someone who only bought at the top. Here's a real-world example to put this in perspective. During the 2008 financial crisis, the S&P 500 dropped roughly 57% from its peak in October 2007 to its bottom in March 2009. If you had been investing $500 a month throughout that whole period, you would have been buying shares at dramatically reduced prices during the worst months of the crash. By the time the market fully recovered in early 2013, your portfolio would have grown significantly beyond just recovering your losses. Because you'd accumulated so many low-cost shares during the downturn. This is compounding, working in your favor during a crash. You're not just surviving it, you're using it. Now let's talk about the 3 phases of a market crash and what to do in each one. Every market crash tends to move through 3 recognizable stages. Understanding each one helps you stay rational when emotions are running high. Phase 1, the euphoria before the fall. This is the stage we may be moving out of right now in 2026. Prices are high, everyone is optimistic, and it feels like things will keep going up forever. In this phase, the most important thing you can do is prepare. Not by selling everything, but by making sure your financial foundation is solid. First, review your emergency fund. You want at least 3 to 6 months of living expenses sitting in a high-yield savings account. As of 2026, many high-yield savings accounts are still offering rates in the 4 to 5% range, which means your emergency cash is actually earning something while it sits there. This matters because if a crash hits and you lose your job, or business slows down, you do not want to be forced to sell investments at a loss just to pay your rent. Second, check how diversified your investments are. One of the biggest mistakes people make during a bull market is letting 1 or 2 winning stocks take over their entire portfolio. If Tesla triples in value and now represents 60% of your portfolio, that's not a winning position. That's a massive concentration of risk. Diversification doesn't mean you won't lose money in a crash. It means no single crash in a single sector can wipe you out completely. Third, and this is important, reduce any leverage positions you have. If you're investing with borrowed money, something called margin, a significant market drop can trigger what's called a margin call, where your brokerage forces you to sell your stocks at the worst possible time to recover the debt. If you're in this position, reducing that leverage before a crash hits is one of the most important things you can do. Phase 2, the actual crash. This is the hardest phase. Because of the math is simple. Buy more when things are cheap, but because of the psychology. Watching your portfolio drop 30%, 40%, 50% is genuinely terrifying, and every instinct you have is going to be screaming at you to do something, to stop the bleeding, to get out. This is where most people make the mistake that costs them years of compounding. The key to getting through this phase is understanding why you own what you own. If you're invested in broad index funds, like a total US stock market fund or an S&P 500 index fund, you're not betting on one company, you're betting on the collective performance of hundreds of American businesses. And if all of those businesses go to zero and never recover, you've got much bigger problems than your portfolio. Historically, the S&P 500 has recovered from every single crash in its history. Everyone. The average bear market has lasted about 289 days, less than 10 months. The average bull market that follows has lasted over 900 days. The recoveries are always longer and stronger than the crashes. So in this phase, your job is simple. Even if it's hard, don't sell. And if you can, keep buying. Your $200 a month buys twice as many shares when the market is down 50%. Every share you accumulate at those lower prices is a future gain when things recover. And they will recover. Phase 3. The recovery. This is the phase where the compounding payoff becomes visible. After a crash, markets don't just return to where they were, they typically push past prior highs. That's been true after Black Monday in 1987, the dot-com crash in 2000, the 2008 financial crisis, and the 2020 pandemic crash. Each time new all-time highs followed. The 2020 crash is probably the most dramatic recent example of this. The S&P 500 dropped around 34% in just a few weeks between February and March 2020. It was fast, it was brutal, and the financial media was full of doom and gloom. But by August of the same year, just 5 months later, the market had completely recovered and hit new all-time highs. The people who sold in March 2020 locked in losses and likely missed one of the fastest recoveries in stock market history. The people who came out of those crashes significantly wealthier weren't the ones who timed the market perfectly. They were the ones who stayed consistent. They kept investing during the scary parts. They didn't let panic override their plan. In this recovery phase, the compounding engine that kept running through the crash, powered by all those extra shares you bought at lower prices, starts to really show its results. It's in this phase that patient investors often look back and realize the crash was, financially, one of the best things that ever happened to them. Not because losing money is fun, but because it gave them the chance to buy great assets at a fraction of their real value. Let me put all of this together with some real numbers, because I think this is where everything clicks. Let's say you have two people, person A and person B. Both are 35 years old. Both have $20,000 invested. Both contribute $300 a month. The only difference is what they do when the 2026 crash hits. Person A panics. The market drops 40% and they move everything to cash in March 2026. They stay in cash for 2 years, waiting for things to feel safer. They miss the initial recovery. They eventually reinvest in early 2028 when things look stable again, but they've missed some of the best trading days of the recovery period. Person B does nothing. They keep their $300 monthly contribution going without missing a single month. During the deepest part of the crash, their $300 buys significantly more shares than it did before. When the recovery comes, all those extra shares start compounding at the higher prices. By the time both of them are 65, assuming the historical average return of around 10% annually, Person B's portfolio could realistically be $200,000 to $400,000, larger than Person A's, purely because of the compounding gap created by 2 years of sitting on the sidelines. That's the cost of fear. Not a small cost, a life-changing cost. And maybe he also opened his YouTube channel. Since YouTube, it's blowing up every small channel that does things right, as I teach you in my free community with the link below. This is why the most powerful thing you can do, heading into a potential 2026 market crash, isn't finding some clever way to time the market. It's making sure your system is set up so that you can stay the course, no matter what happens. So, in the end, here's what I want you to take away from today. Market crashes are not the enemy. Panic is the enemy. Compounding's one of the most powerful forces in personal finance, but it requires time and consistency to work. The moment you break the chain by selling out of fear, you don't just lose the value of your investments, you lose all the future compounding those investments would have generated. If a crash is coming, and the data suggests we may be due for one, here's what your action plan should look like. Make sure you have a solid emergency fund in a high-yield account so you're never forced to sell investments at a bad time. Make sure your portfolio is diversified so no single sector crash can destroy everything. Reduce any margin or leverage positions before things get ugly. And most importantly, set up a consistent monthly investment contribution and commit to keeping it going no matter what the market does. That's how you use compounding to survive a crash. Not by avoiding the crash, but by making sure the crash works for you instead of against you. The investors who will look back at 2026 as a turning point in their financial lives are the ones who stayed calm, stayed invested, and kept buying while everyone else